There is a lie at the heart of modern finance, a comfortable, soothing lie told so often that it has become an unquestionable truth. It is whispered by financial advisors in hushed, reassuring tones. It is plastered across the websites of brokerage firms and shouted from the studios of financial news networks. The lie is this: safety is found in numbers. The more stocks you own, the more diversified you are, the safer your money will be. They call it a well-diversified portfolio, and they sell it to you as the only responsible path to wealth creation. They tell you to buy a little bit of everything, to spread your bets so widely that no single failure can hurt you too badly. And in doing so, they guarantee you one thing: mediocrity. They guarantee that your best ideas, your most brilliant insights, the moments where you are truly right about the future, will be drowned in a sea of average. Your flashes of genius will be canceled out by your mundane holdings. Your home runs will be neutered by your strikeouts. And your financial journey will be a long, slow, and tedious crawl towards a finish line that is always just a little further away than you hoped. This philosophy of wide diversification is not a strategy for building wealth. It is a strategy for not getting fired. It protects the wealth management industry from blame, because if you own a piece of the entire market, you can only ever perform like the market. You can never be spectacularly wrong, but you are forbidden from ever being spectacularly right. And that is the trade-off millions of investors make every single day, without ever realizing they are being sold a false promise. They are trading the real possibility of financial freedom for the illusion of safety. But there is another path. A path walked by the infinitesimally small number of investors who have achieved truly staggering results, who have not just beaten the market but have redefined what is possible within it. This path is narrower, more demanding, and requires a level of intellectual honesty and emotional courage that the 99% of investors simply do not possess. It is the path of concentration. It is built on a radically different thesis. For the investor who is willing to do their homework, who is willing to treat investing not as a game of chance, but as the act of buying a piece of a business, wide diversification is a catastrophic mistake. It is, in the words of Warren Buffett, a protection against ignorance. It makes very little sense for those who know what they're doing. The principle is simple yet profound. True wealth is not built by spreading your capital thinly across 100 different ideas. It is built by identifying a tiny handful of truly exceptional opportunities and backing them with immense conviction. It is about making your best ideas count. It is about having the courage to put a significant portion of your capital behind your deepest research, allowing your insights to have a meaningful, transformative impact on your net worth. This is not about being reckless. It is the exact opposite. It is about replacing the blind faith of diversification with the hard-won confidence of deep knowledge. It is about trading the false safety of the crowd for the genuine security of understanding exactly what you own and why you own it. Over the course of our journey together today, we will dismantle the myth of diversification piece by piece. We will replace it with a robust, logical, and actionable framework for building a small portfolio that can create real, life-changing wealth. This is the final promise of investing, a promise not of average returns but of exceptional ones. And it begins by unlearning the very first thing you were ever taught about money. Our first task is to confront the dominant paradigm head-on, to pull back the curtain on the great illusion of safety that has been constructed around the concept of wide diversification. We must understand why this idea is so seductive, so pervasive, and why, for the thinking investor, it is a siren song leading to a destination of mediocrity. The entire financial industry is built on the premise that the future is unknowable, and therefore, the only rational response is to prepare for every eventuality by owning a slice of everything. This is a brilliant business model for the industry, as it encourages the creation of endless products, mutual funds, exchange-traded funds, each offering a slightly different flavor of the same core idea. But it is a flawed model for the individual seeking not just to preserve capital but to dramatically grow it. The true purpose of this pillar is to deconstruct the myth of wide diversification, to expose it not as a sophisticated risk management tool, but as a confession of ignorance masquerading as wisdom. We will see that for the investor who does their homework, it is not just suboptimal, it is a direct impediment to success. To understand the power of concentration, we must travel back in time, not to a sterile boardroom or a frantic stock exchange, but to the dusty, chaotic world of mid-20th century American business. Our story begins in 1963, a year of immense cultural and political turmoil. But in the world of finance, the most dramatic story was unfolding in the unassuming warehouses of Bayonne, New Jersey, home to the Allied Crude Vegetable Oil Refining Company. The company, run by a charismatic fraudster named Tino De Angelis, was a major player in the vegetable oil market. It stored vast quantities of soybean and cottonseed oil, which it used as collateral to secure massive loans from dozens of Wall Street firms and banks. One of its biggest customers, the one lending it the most money against this supposed inventory, was a division of American Express. The company was known for its traveler's checks and credit cards, but it had a thriving field warehousing business, where it would certify the contents of a company's storage tanks and issue receipts, which could then be used as collateral. The system was built on trust, and that trust was about to be shattered. In November of 1963, a tip-off led inspectors to Allied's warehouses. What they found was a fraud of breathtaking audacity. The vast majority of the company's supposed 64 towering storage tanks were empty. Others were filled with water, with only a thin layer of valuable salad oil floating on top to deceive the inspectors. Tino De Angelis had been borrowing against phantom inventory. The company was a house of cards, and it collapsed overnight, defaulting on what would be, in today's money, over $1 billion in loans. The fallout was immediate and catastrophic. Wall Street panicked. Dozens of firms were facing bankruptcy. The biggest victim, in the public's imagination, was American Express. The market reasoned that since American Express's subsidiary had issued the receipts for the phantom oil, it would be on the hook for all the losses. The fear was palpable. Investors, gripped by uncertainty, dumped the stock en masse. The share price of this blue-chip institution was sliced in half, plummeting from over $60 a share to just $35. The consensus on Wall Street was clear: American Express was facing ruin. Avoid it at all costs. But in Omaha, Nebraska, a young 33-year-old money manager named Warren Buffett saw not a disaster but the opportunity of a lifetime. While the rest of the world was panicking, Buffett did something radically different. He did his homework. He didn't just look at the stock price, he went out to investigate the underlying business. He started by going to his local banks in Omaha and talking to the tellers and officers about American Express travelers' checks. Were people still using them? Were they still trusted? The answer was a resounding yes. The brand was as strong as ever. He then talked to travel agents, corporate travel departments, and even his friends. The story was the same everywhere. The salad oil scandal was a Wall Street story. It had not damaged the core, incredibly profitable businesses of the American Express brand in the minds of the public. He then went further, walking into restaurants and stores, observing people paying for their meals. He noticed something critical. People were still proudly using their American Express cards. The scandal hadn't dented the prestige of the brand one bit. Buffett's deep, on-the-ground research led him to a conclusion that was the polar opposite of the market's consensus. He calculated that while the company would face some losses from the scandal, its fundamental earning power from travelers' checks and credit cards was so immense that it could absorb the hit and still be fantastically cheap at the current stock price. He realized the market was confusing a temporary manageable problem at a subsidiary with a mortal wound to the entire enterprise. So what did he do? He didn't sprinkle a little bit of money into the stock as a speculative bet. He didn't add it as the 50th position in a widely diversified portfolio. He acted with enormous conviction. Buffett took 40% of his entire partnership's capital, 40%, and poured it into American Express stock. It was the single largest investment he had ever made. For his partners, a collection of doctors, lawyers, and business people from Omaha, This was a terrifying proposition. They were entrusting their life savings to this young man who was now betting the farm on a single company that the rest of the world believed was on the brink of collapse. This was the antithesis of diversification. It was the epitome of concentration. And, of course, he was proven spectacularly right. Within 2 years, the scandal faded, the company's powerful earnings shone through, and the stock price more than tripled. That single, concentrated bet was a major catalyst that would launch Buffett's career into the stratosphere, generating legendary returns for his partners and laying the foundation for Berkshire Hathaway. This anecdote is not just a story about a great stock pick. It is the foundational lesson in why concentration, backed by diligent research, is superior to diversification. While the diversified investor was protected from the fall of American Express, they were also completely excluded from its phenomenal rise. Their fear, spread thinly across 100 stocks, earned them an average return. Buffett's courage, concentrated in one brilliant idea, created a fortune. The story of American Express and the salad oil scandal reveals a deep-seated flaw in human psychology that drives the herd towards the false comfort of diversification. The primary cognitive bias at play is what psychologists call ambiguity aversion. This is our natural tendency to prefer risks we think we can quantify over risks that feel uncertain or unknown. A diversified portfolio of 500 stocks, like an S&P 500 index fund, feels like a known risk. Financial advisors can show you charts of its historical performance, its standard deviation, its beta. It feels predictable. The expected return is, well, average. The risk of ruin feels close to zero. This is a comfortable, known proposition. A concentrated portfolio of 5 to 10 stocks, on the other hand, feels ambiguous. The potential outcomes are much wider. It could dramatically underperform the market, or it could dramatically outperform it. The future feels less certain. Faced with this choice, the human brain, which is wired for survival above all else, systematically chooses the known, predictable path, even if its potential rewards are significantly lower. We opt for the guaranteed mediocrity of the index fund over the ambiguous but potentially life-changing returns of a concentrated portfolio. We hate ambiguity more than we love the prospect of great wealth. This is compounded by the powerful force of herd behavior. As social creatures, we are programmed to find safety in numbers. If everyone around us is diversifying, if every financial expert on television is preaching its virtues, then our instinct is to do the same. To concentrate is to step away from the herd, to stand alone in your conviction. This is psychologically terrifying. If you are wrong on a concentrated bet, the failure is yours and yours alone. There is no one else to blame. The regret is immense. If, however, you own a diversified portfolio and it performs poorly, you can comfort yourself with the knowledge that everyone else is in the same boat. You simply failed conventionally. As the great economist John Maynard Keynes noted, it is better for reputation to fail conventionally than to succeed unconventionally. The entire financial services industry is built on this psychological truth. It is far easier and safer for a wealth manager to put all of their clients in the same 100-stock portfolio than to make a handful of high-conviction bets. If the bets go wrong, the manager looks like a reckless fool. If the diversified portfolio goes down with the market, the manager just looks unlucky. The path of the 99% is paved by this deep-seated fear of being different, this aversion to ambiguity. We choose diversification not because it is mathematically superior for creating wealth, but because it is psychologically comforting. It is an emotional anesthetic, numbing us to the fear of the unknown at the cost of our financial potential. So how do we translate this understanding into a practical tool, a blueprint that can guide our own investment decisions? The most powerful mental model to overcome the siren song of diversification is the circle of competence. This concept, popularized by Buffett, is elegantly simple. Each of us, through our careers, our studies, and our hobbies, has built up specialized knowledge in certain areas. A software engineer has a deep understanding of the tech industry. A doctor understands the healthcare system. A marketing executive understands consumer brands. Your circle of competence is the area where you have a genuine, demonstrable edge in understanding. The blueprint for applying this is a rigorous process of elimination. Step 1. Take out a piece of paper and list the industries you genuinely understand. Not the ones you find exciting or read about in the news, but the ones where you could hold an intelligent, hour-long conversation with an expert in the field. Be brutally honest. For most people, this list will be very short, perhaps only 1 or 2 industries. Step 2. Within those industries, list the specific companies whose business models you can articulate simply and clearly. Could you explain to a reasonably intelligent high school student how this company makes money, who its customers are, and what service it provides? If the business model involves complex financial engineering or technology you don't grasp, it's outside your circle. Step 3. For the remaining handful of companies, ask the most important question: what is this company's durable competitive advantage? What special something does it have? A powerful brand, a network effect, a low-cost production process, a regulatory license that protects it from competitors. If you cannot clearly identify this moat, as Buffett calls it, cross the company off the list. After this filtering process, you will not be left with 100 potential investments. You will be lucky if you are left with 5 or 10. And that is the entire point. This exercise is not about finding things to buy. It is about eliminating almost everything. It forces you to say no to 99.9% of the market. The result is a pre-concentrated universe of potential investments, each one falling squarely within an area where you have a real intellectual advantage. Building a portfolio from this tiny, well-understood list is no longer a reckless act of concentration. It is the most rational, risk-averse strategy imaginable, because you are confining your capital to the only areas where you are qualified to deploy it. This is the antidote to ambiguity aversion. Within your circle, the risks are no longer ambiguous. They are knowable, analyzable, and manageable. To truly appreciate the wisdom of this focused approach, we must spend some time examining its opposite, the path of the 99%, the path of the typical retail investor. This investor's journey usually begins with good intentions. They've saved some money and they know they should be investing it. They open a brokerage account and are immediately confronted with a dizzying array of thousands of stocks, funds, and options. Overwhelmed by the paradox of choice, they begin to assemble a portfolio based on fragments of information. They buy some Apple and Google because they use their products. They buy a little bit of an oil company because they heard energy prices are going up. A friend at a dinner party tells them about a hot biotech stock with a revolutionary new drug, so they add a small position. They see a financial news segment about the promise of emerging markets, so they buy an international ETF. Over a few years, their portfolio grows not by design, but by accumulation. It becomes a haphazard collection of 50, 75, even 100 different holdings. They have created what is known as a closet index fund. It's a portfolio so diversified that it mimics the performance of the broad market, but it comes with far greater costs. They pay transaction fees on every one of those buys. They spend hours trying to keep track of dozens of different companies. And when it comes time to pay taxes, they face a nightmare of tracking cost basis on countless small positions. Worst of all, they have achieved the illusion of diversification without any of its supposed benefits. Their best idea, perhaps that initial investment in Apple that has tripled in value, is so diluted by the other 99 holdings that its brilliant performance is barely noticeable in their overall net worth. A 10% gain in their 1% position in Apple adds a measly 0.1% to their total portfolio value. They have effectively vaccinated themselves against the possibility of getting rich. This investor hasn't managed risk. They have guaranteed mediocrity. They have mistaken activity for progress and accumulation for strategy. They are a collector of stocks, not an owner of businesses, and their financial future is shackled to the whims of the market average. The direct financial connection here is not just theoretical, it can be quantified with brutal clarity. Let's compare two investors, both starting with a $100,000 portfolio. Investor A is the diversifier. She follows the conventional wisdom and builds a portfolio of 50 stocks, allocating 2% of her capital to each. Investor B is the concentrator. After doing immense research to stay within her circle of competence, she builds a portfolio of just 5 stocks, allocating 20% of her capital to each. Now, let's assume both investors have a stroke of genius. They both identify a phenomenal company that proceeds to double in value over the next year, a 100% return. For Investor A, the diversifier, this brilliant insight has a disappointingly small impact. Her 2% position doubles, meaning her $2,000 investment becomes $4,000. This $2,000 gain on a $100,000 portfolio represents a mere 2% increase in her total net worth. Her genius was diluted into irrelevance. Now consider Investor B, the concentrator. Her 20% position also doubles. Her $20,000 investment becomes $40,000. This $20,000 gain on her $100,000 portfolio represents a massive 20% increase in her total net worth. Her genius was allowed to have a meaningful, wealth-creating impact. The opportunity cost of Investor A's diversification is a staggering $18,000 in a single year on a single great idea. Extend this over a lifetime of investing, and the difference in outcomes is not just significant. It is the difference between a comfortable retirement and true financial freedom. Wide diversification doesn't just reduce your risk of being wrong, it eliminates your reward for being right. It is a mathematical ceiling placed on your potential for wealth creation. When you spread your capital too thin, you are not just managing risk, you are actively choosing to dilute the financial impact of your best thinking. And that is a price that no intelligent investor should be willing to pay. Having dismantled the flawed logic of wide diversification, we arrive at the foundational pillar of the concentrated investor's creed, the supreme power of deep knowledge. If we are to abandon the shotgun approach of owning everything, we must replace it with the sniper rifle precision of knowing a few businesses intimately. This is the core trade-off. We are trading breadth for depth. The concentrated investor's advantage does not come from predicting the market or having a crystal ball. It comes from a profound, almost obsessive understanding of a handful of enterprises. They are not playing the stock market. They are becoming part owners of businesses they comprehend as well as if they had founded them. This pillar is about recognizing that in the world of investing, a superficial understanding of many things is a liability, while a deep understanding of a few is the ultimate asset. It is this informational and analytical edge that transforms the act of concentration from a gamble into a highly rational, calculated strategy for wealth creation. Our next foundational anecdote takes us to the bleak economic landscape of 1973. The United States was mired in stagflation, an energy crisis, and the political fallout of the Watergate scandal. The stock market was in the midst of a brutal bear market that would ultimately cut its value in half. Investor sentiment was at rock bottom. It was a time of fear, pessimism, and indiscriminate selling. It was, in other words, a perfect environment for a disciplined, knowledge-driven investor. During this period, Warren Buffett began to take a very close look at the Washington Post Company. On the surface, it looked like just another struggling newspaper business in a terrible economy. Its stock price had been hammered along with the rest of the market. But Buffett, as was his habit, looked past the stock price and delved deep into the underlying business. He didn't just glance at the latest quarterly earnings report. He obtained and read decades of the company's annual reports. He wasn't just analyzing numbers, he was absorbing the company's history, its culture, and its strategic evolution. What he discovered was a business of extraordinary quality hidden in plain sight. The Washington Post newspaper had a virtual monopoly in its market. In the pre-internet era, this was an unassailable competitive advantage, a true fortress. Local advertisers had no other effective way to reach the city's population. This gave the company tremendous pricing power and predictable, gushing cash flows. Furthermore, the company was controlled and run by Katharine Graham, a a woman Buffett came to admire immensely for her integrity and her focus on journalistic quality over short-term profits. He saw a steward of capital who was aligned with the long-term interests of the business. But the real key to his insight was his valuation work. Wall Street analysts were valuing the entire Washington Post company at around $80 million. Buffett, however, did a piece-by-piece analysis. He looked at the company's other assets, which included Newsweek magazine and several highly profitable television stations. He calculated that the television stations alone were worth more than the entire $80 million market capitalization. This meant that an investor was getting the world-class Washington Post newspaper, a national news magazine, and other assets for free. The market, in its panic, was making a colossal error of judgment, focusing on the gloomy headlines of the day instead of the enduring economic reality of the business. Armed with this deep, almost encyclopedic knowledge, Buffett acted with his characteristic conviction. Through 1973, Berkshire Hathaway began accumulating shares, eventually investing over $10 million to acquire about 10% of the company. At the time, this was a massive position for Berkshire. It was a concentrated bet on a single company in a deeply unpopular industry during a terrifying bear market. Many would have called it reckless. But it was the opposite. His deep knowledge of the business, its competitive moat, its management, and its absurd undervaluation provided him with an enormous margin of safety. He knew the business was worth far more than he was paying for it. The risk of permanent capital loss was, in his mind, minuscule, regardless of what the stock price did in the short term. The investment was a staggering success. Over the next 30 years, that $10 million investment would grow to be worth over $1 billion, a hundredfold return. This was not luck. It was the direct result of substituting the superficial knowledge of the many for the profound knowledge of the few. While other investors were panicking over the economy, Buffett was calmly reading annual reports, understanding the fundamental business economics that market sentiment could not change. He wasn't just buying a stock, he was buying a piece of an extraordinary, undervalued business that he understood inside and out. The Washington Post story perfectly illustrates the psychological trap that ensnares the average investor, the Dunning-Kruger effect. This cognitive bias describes a phenomenon where people with low ability at a task overestimate their ability. In investing, the novice who reads a few headlines on a company or watches a segment on financial television often feels a misplaced sense of expertise. They mistake familiarity with a company's name or product for a genuine understanding of its business model, competitive landscape, and financial health. They believe they are making an informed decision when, in reality, their knowledge is dangerously superficial. This is directly linked to the problem of information overload. In the modern era, we are bombarded with a ceaseless stream of financial news, analyst ratings, and market chatter. The 99% believe that consuming more of this information will make them better investors. They equate the quantity of information with the quality of their decisions. The reality is the precise opposite. This fire hose of noise leads to a shallow, mile-wide, inch-deep understanding of dozens of companies. It encourages reactionary, short-term thinking and makes it impossible to develop the deep, patient knowledge required for successful long-term investing. The concentrated investor deliberately rejects this approach. They understand that their time and mental energy are finite resources. Instead of trying to follow 50 companies, they choose to follow 5 with an obsessive level of detail. They build a protective wall against the noise of the market, focusing instead on the signal, the long-term fundamentals of the businesses they own. This deep knowledge inoculates them against the emotional swings of the market. When the price of their stock falls, they don't panic, because their confidence is rooted not in the stock price, but in their deep understanding of the business's intrinsic value. The practical blueprint for developing this level of deep knowledge is a method championed by the legendary investor Philip Fisher and adopted enthusiastically by Buffett, the scuttlebutt or investigative approach. This mental model transforms you from a passive reader of financial statements into an active business analyst. It is a checklist for performing the kind of due diligence that concentration demands. Step 1. Become a historian of the company. Don't just read the latest annual report, read the last 10. Read every shareholder letter the CEO has written. This allows you to see how management has performed against its own stated goals over time. Have they been honest? Have they delivered on their promises? Step 2. Go beyond the company's own publications. Talk to the stakeholders of the business. If it's a retail company, visit its stores and talk to the employees and the customers. What is the morale like? Are the customers passionate about the product? If it's a business-to-business company, try to talk to its key suppliers and its major customers. Why do they do business with this company instead of its competitors? Step 3. Investigate the competition. Do the same deep dive on the company's main rivals. What are their strengths and weaknesses? What makes your target company better or worse? This provides crucial context for understanding its competitive advantage. Step 4. If possible, and with proper ethical considerations, talk to former employees of the company. They can often provide an unfiltered view of the company's culture and operational strengths or weaknesses. This entire process is labor-intensive. It takes weeks, even months, to do properly for a single company. And that is why it is so effective. It forces you to focus your energy. You simply cannot do this for 50 companies. By committing to this deep investigative work, you are naturally guided towards a concentrated portfolio because you will only have the time to develop this level of conviction in a very small number of ideas. It replaces the passive, superficial analysis of the masses with an active, deep understanding that provides a true and sustainable edge. Now let us contrast this diligent investigative approach with the path of the 99%, which can be best described as the path of the story stock investor. This individual is not buying a business, they are buying a narrative. They are drawn to companies with exciting, easy-to-understand stories, often in glamorous, high-growth sectors. This company is the next Tesla. This one is revolutionizing healthcare with artificial intelligence. This social media app is going to be bigger than Facebook. The story is compelling, and the investor, captivated by the narrative, makes a purchase without ever looking under the hood. They wouldn't dream of reading a 10-year-old annual report. They have no idea what the company's profit margins are, how much debt it has, or who its main competitors are. Their investment thesis is not based on numbers or a deep understanding of the business model, but on a vague and hopeful belief in the story. This approach is incredibly dangerous because stories are fragile. When the company hits an inevitable rough patch, a competitor launches a better product, a clinical trial fails, user growth slows, the story breaks. And because the investor's conviction was based solely on that fragile narrative, they have nothing to fall back on. Their confidence shatters, and they panic sell, often at the worst possible moment. The deep knowledge investor, by contrast, is a business owner. Their conviction is not based on a story, but on a deep understanding of the company's enduring competitive advantages and long-term earning power. When the stock price falls, they are able to calmly reevaluate the situation. Has the long-term business case been broken? Or is this just a temporary setback, a short-term story that the market is overreacting to? More often than not, they conclude it's the latter, and they use the price decline as an opportunity to buy more of the great business at a better price. The story stock investor is a renter of stocks. The deep knowledge investor is an owner of businesses, and over the long run, the owners always win. The direct financial connection of deep knowledge manifests in one of the most critical concepts in all of investing, the margin of safety. This principle, first articulated by Benjamin Graham, Buffett's mentor, is the bedrock of true risk management. The idea is simple. You must only buy a security when its market price is significantly below your calculation of its intrinsic value. Intrinsic value is the true underlying worth of a business, based on its future cash flows. The margin of safety is the discount between that value and the price you pay. It is your buffer against bad luck, errors in judgment, and the unpredictable turmoil of the market. Here is the crucial link. You cannot have a reliable margin of safety without deep knowledge. A superficial understanding of a company leads to a vague, fuzzy, and unreliable calculation of its intrinsic value. You might guess that a company is worth around $100 per share. But this is just a guess. The deep, scuttlebutt-style research we have described allows for a much more rigorous and confident estimation of intrinsic value. You understand the drivers of the business's profitability, the sustainability of its competitive advantages, and the likely trajectory of its future earnings. This allows you to build a detailed financial model and arrive at a much narrower, more defensible range for its intrinsic value. For example, your deep research might lead you to conclude with high confidence that a business is worth between $120 and $140 per share. If that company's stock is currently trading at $70, you have a massive margin of safety. You are paying 70 cents for a dollar's worth of business value. This is what gives the concentrated investor the courage to act. The financial power of this is twofold. First, it dramatically reduces the risk of permanent capital loss. Even if your valuation is a bit optimistic, or the company stumbles, the large discount provides a cushion. Second, it provides the fuel for enormous capital gains. When the market eventually recognizes its mistake and the stock price rises to reflect the company's true intrinsic value, the investor who bought with a large margin of safety reaps a spectacular return. Deep knowledge is the raw material from which a margin of safety is built. Without it, you are simply guessing. With it, you are investing with a built-in, quantifiable advantage that is the ultimate source of both safety and superior returns. We have established that diversification is a trap and that deep knowledge is the key to escape. Yet there remains a formidable barrier between understanding this intellectually and actually implementing it. This barrier is not financial, it is psychological. To move from a portfolio of 50 stocks to a portfolio of 5 requires more than just analytical skill. It requires a profound level of emotional fortitude. This is the courage of conviction. It is the ability to stand firm in your beliefs when the entire world seems to be telling you that you are wrong. It is the discipline to bet heavily on your best ideas and the patience to hold them through periods of intense market volatility and public doubt. The third pillar of our journey, therefore, is about mastering the inner game of investing. It is about understanding the powerful cognitive biases that push us toward the safety of the herd, and developing the mental toughness required to forge our own path. Without this psychological leap from what Peter Lynch called diversification to true concentration, even the most brilliant stock analysis is useless, as it will be abandoned at the first sign of trouble. Our guiding anecdote for this pillar centers on perhaps the most famous and successful investment of Buffett's career: Coca-Cola. The story begins in the summer of 1988. After the shocking market crash of October 1987, fear still lingered in the air. But Buffett, ever the business analyst, was looking at fundamentals, not market sentiment. He began to study Coca-Cola with an intensity that bordered on obsession. He drank the product, of course, but he did much more. He read every annual report. He traveled to talk with Coca-Cola bottlers and competitors around the world. He spoke with the company's longtime friend and lawyer, Don Key, questioning him for hours about the brand's global power. He came to a powerful conclusion. Coca-Cola was not just a beverage company. It was arguably the single best business in the world. Its brand was a global icon, a piece of mental real estate in the minds of billions of people that was virtually impossible to replicate. This gave it a permanent share of mind, which translated into a permanent share of market. Its business model was brilliantly simple and incredibly lucrative, requiring little capital to grow. Based on this deep conviction, Buffett made one of the boldest moves in investment history. Over a period of several months in 1988, Berkshire Hathaway invested over $1 billion to buy shares of Coca-Cola. At the time, this represented nearly a quarter of Berkshire's entire book value. It was a bet of monumental proportions. But the true test of his conviction was not in the buying, it was in the holding. Over the subsequent years, Coca-Cola faced numerous challenges. There was the infamous New Coke fiasco years earlier, a marketing blunder that had temporarily shaken faith in the management. There were constant news cycles about the health risks of sugary drinks. There were periods of intense competition from Pepsi. There were years where the stock price went essentially nowhere, testing the patience of any investor. A typical, less convicted investor would have been tempted to sell many times over. They would have seen the flat stock price and concluded the story was over. They would have read the negative headlines about sugar and sold out of fear. They would have been tempted to take their profits after the stock doubled, rather than holding on for the grand slam. But Buffett's conviction was not based on the stock price or the daily news. It was based on his unshakable understanding of the business's durable competitive advantage. He knew that despite the noise, billions of people around the world would continue to reach for a Coke every single day. His courage allowed him to hold on, and the results were legendary. That $1 billion investment blossomed into a position worth over $25 billion today, not including the billions upon billions in dividends Berkshire has received over the decades. This story is the ultimate testament to the courage of conviction. The analysis identified the opportunity, but it was the psychological fortitude to bet big and hold on through thick and thin that generated the world historical return. The immense psychological challenge of holding a concentrated position like Coca-Cola stems from two of the most powerful and primitive biases in the human brain: loss aversion and regret aversion. Groundbreaking research by psychologists Daniel Kahneman and Amos Tversky showed that the pain of losing $1 is roughly twice as powerful, emotionally, as the pleasure of gaining $1. Our brains are wired to avoid loss at all costs. When you have 40% of your net worth in a single stock and it drops 10%, the psychological pain is immense and overwhelming. The instinct to sell, to make the pain stop, is almost irresistible. In a diversified portfolio, a 10% drop in one of your 50 stocks is a minor annoyance, a blip on your statement. You feel almost nothing. Concentration magnifies the emotional impact of volatility, and loss aversion makes it incredibly difficult to endure. This is compounded by regret aversion, our deep-seated fear of making a decision that turns out to be wrong in hindsight. If you buy a diversified index fund and it goes down, you don't feel much personal regret. The entire market went down. It wasn't your fault. But if you make a conscious, deliberate decision to put a large sum of money into one stock and it goes down, the feeling of regret can be crushing. You feel foolish. You blame yourself. To avoid this painful emotion, most people choose to diversify. Diversification is, in essence, a strategy to avoid regret. It ensures that no single decision can ever be too wrong, and therefore, no single decision can ever cause you too much psychological pain. The master investor, however, reframes this entire concept. They understand that the greatest investment regret is not losing money on a single idea, but the regret of not betting enough on your absolute best idea. The real financial tragedy is identifying a Coca-Cola in 1988 and only buying a tiny, insignificant position. The courage of conviction is about overcoming these deep-seated fears by anchoring yourself to logic, research, and a long-term perspective. To build this necessary courage, we can employ a powerful mental model from the Stoic philosophers, which has been championed by modern thinkers like Charlie Munger, the practice of inversion. Instead of thinking forward about all the ways an investment could go right, you invert the problem and think backward about all the ways it could be a total disaster. The blueprint for applying this is a structured pre-mortem analysis. Before you invest, you ask yourself, let's assume it's 5 years from now, and this investment has failed catastrophically, losing most of its value. What happened? You then write out, in detail, all the possible scenarios that could have led to this failure. For a company like Coca-Cola, the list might look like this. 1. A global, government-led crackdown on sugary drinks that cripples sales. 2. A new, disruptive competitor emerges with a product that consumers vastly prefer. 3. The Coca-Cola brand somehow becomes toxic or unfashionable, losing its share of mind. 4. Management makes a series of terrible capital allocation decisions, destroying shareholder value. Once you have this list of disaster scenarios, you can then go back and research the probability of each one actually occurring. How likely is it, really, that every government on Earth will coordinate to ban Coke? How has the brand held up against competitors for the last 100 years? What is the track record of the current management team? By systematically confronting the worst-case scenarios and analyzing them rationally, you strip them of their emotional power. More often than not, for a truly great business, you will find that the probability of these catastrophic failures is exceedingly low. This process doesn't eliminate risk, but it defines it. It separates legitimate business risks from the amorphous fear and market noise. When you have stared into the abyss, analyzed it, and concluded it is a manageable threat, your conviction solidifies. It becomes a rational, battle-tested belief, not just a hopeful opinion. This is the source of the courage needed to hold on when the market inevitably tests your resolve. The antithesis of this patient, conviction-driven approach is the path of the 99%, which is dominated by what psychologists call action bias. This is the human tendency to feel compelled to do something, even when doing nothing is the best course of action. The typical investor is a perpetual tinkerer. They check their portfolio multiple times a day. They watch the financial news and feel an urgent need to react to every headline. If a stock they own has a good run, they feel the itch to sell and lock in profits. If a new, exciting technology comes along, they feel they are missing out and need to sell something old to buy something new. They mistake this constant activity for progress and intelligent portfolio management. The concentrated long-term investor understands a fundamental truth. In investing, lethargy, bordering on sloth, is a great virtue. Once you have identified a wonderful business and bought it at a fair price, the best thing to do is almost always nothing. You must let the business compound its value over years and decades. Buffett famously said his, quote, favorite holding period is forever. This is because the real money in investing is not made in the buying or the selling, but in the waiting. The action-biased investor is like a gardener who keeps pulling up his carrots to see how they're growing. The patient, concentrated investor plants a few mighty oak trees and then has the wisdom to sit in the shade for decades while they grow to maturity. This requires a level of discipline that is completely alien to most people. It is the courage to be boring, the strength to sit still while everyone else is running around, and it is one of the most significant, yet least appreciated, secrets to building extraordinary wealth. The direct financial connection of this courage of conviction is profound and has two primary components: the minimization of taxes and transaction costs. These two forces are the silent killers of long-term returns. Let's imagine the hyperactive, action-biased investor. Every time they sell a winning stock, they trigger a capital gains tax event. If they've held the stock for less than a year, they pay taxes at their high ordinary income tax rate. Every trade, both buying and selling, also racks up transaction costs, like brokerage commissions and bid-ask spreads. These may seem small on an individual basis, but over a lifetime of constant tinkering, they create a massive drag on performance. Now consider the patient, concentrated investor. By holding their handful of high-conviction stocks for years or decades, they almost entirely avoid these wealth-destroying frictions. They defer capital gains taxes for an incredibly long time, allowing their entire investment to compound tax-free year after year. This is a huge, often underestimated advantage. An investment that grows at 10% per year untouched will be worth far more after 30 years than an investment that also grows at 10% but has its gains shaved off by taxes every year. The concentrated investor also minimizes transaction costs to near zero because they trade so infrequently. They are not giving a slice of their returns back to their broker and the market makers year after year. Over a 30-year investment horizon, the difference in the final portfolio value between the hyperactive trader and the patient holder can be a staggering 50% or more, even if they have the same raw investment returns before costs and taxes. The courage of conviction, therefore, is not just a psychological virtue, it is a direct and powerful financial strategy. It is the mechanism that allows the magic of tax-deferred compounding, the most powerful force in the universe according to Einstein, to work its wonders on your capital. We have arrived at the practical heart of our philosophy. Having rejected diversification, embraced deep knowledge, and cultivated the courage of conviction, we now need a simple, powerful framework to guide our actual investment decisions. How do we translate these abstract principles into a concrete process for building and managing a concentrated portfolio? For this, we turn to one of Warren Buffett's most brilliant and accessible mental models, the 20-slot punch card analogy. This is not a complex financial formula, but a profound psychological tool designed to force discipline, raise standards, and fundamentally change your relationship with investing. It is the operating system for the concentrated investor, a simple set of rules that, if followed faithfully, makes superior performance almost inevitable. This pillar is the blueprint, the how-to guide that bridges the gap between theory and action, providing you with a tangible method for selecting only the absolute best investment ideas for your limited, high-conviction portfolio. Imagine yourself as a young business school student sitting in a lecture hall. The speaker is not a dry academic, but a living legend of the investment world, Warren Buffett. He walks to the front of the room and makes you a proposition. "I could improve your ultimate financial welfare," he says, "by giving you a ticket with only 20 slots in it. And those 20 slots are all the investments you get to make in a lifetime. And once you've punched through all 20 slots, you can't make any more investments at all." He lets that sink in. The students look at each other, confused. Only 20 investments for an entire lifetime? It sounds impossibly restrictive. But then he explains the power of this limitation. "Under those rules," he continues, "you'd really think carefully about what you did. You'd be forced to load up on the very few things that you'd looked at and thought about and understood. You would make damn sure that you were right." This simple analogy is a masterclass in behavioral finance. It single-handedly solves the biggest problems that plague the average investor. By forcing you to view every investment decision as a precious, finite resource, it instantly changes your behavior. You would no longer buy a stock on a whim or a hot tip. You would no longer dabble in speculative fads. The thought of punching your card for a mediocre idea would be abhorrent. Every single decision would be treated with the gravity and seriousness it deserves. You would have to conduct the deep, scuttlebutt-style research we discussed earlier. You would have to ensure you had an enormous margin of safety. You would have to have the supreme conviction to hold on for the long term, because you couldn't afford to waste a punch on a short-term trade. This mental model is the ultimate filter. It forces you to say no to almost everything, and to wait patiently for the truly extraordinary opportunities, the ones that are so good, so obvious to you, that they are worthy of one of your precious 20 punches. If you look back at Buffett's own career, his greatest wealth-creating investments, American Express, Washington Post, Coca-Cola, See's Candies, Apple, they would all easily fit on that single card, with plenty of slots to spare. The punch card analogy is a powerful psychological trick that leverages two key cognitive biases for our benefit: commitment and consistency bias, and the paradox of choice. The paradox of choice, a concept popularized by psychologist Barry Schwartz, states that while we believe more options are better, an overabundance of choice actually leads to anxiety, indecision, and lower satisfaction. The stock market, with its thousands of choices, is a perfect example. The average investor is paralyzed by this endless menu, leading them to make haphazard, poorly researched decisions. The 20-slot punch card solves this paradox by artificially and drastically constraining your options. It's no longer about picking the best stock out of 5,000. It's about finding one idea that is good enough to be one of only 20 you'll ever have. This immediately clarifies the decision-making process and raises the bar for what constitutes an acceptable investment. This then triggers our natural desire for commitment and consistency. Once we have made a decision that we perceive as significant and public, even if it's only public to ourselves, we feel a strong internal pressure to remain consistent with that commitment. The act of mentally punching the card is a powerful commitment ceremony. It signals to your brain that this is not a casual flirtation. This is a serious, long-term partnership with a business. You have used one of your finite slots. This psychological commitment makes it far easier to stick with the investment through the inevitable periods of volatility. You are no longer just a holder of the stock. You are a defender of your past decision, and you will be more inclined to reaffirm your original research rather than panic at the first sign of trouble. The punch card is not just a filter. It's a commitment device that hardwires a long-term perspective into your investment process. To make the punch card model truly actionable, we need to build a practical, systematic tool to determine whether an investment idea is worthy of a punch. This tool is the Personal Investment Checklist. It is a non-negotiable set of criteria that every potential investment must meet before you even consider deploying capital. While your specific checklist might vary slightly, it must be built around the core principles of business-like investing. Here is a blueprint for a robust 5-point checklist. Criterion 1: the test of simplicity. Can I explain, in simple terms that a 10-year-old could understand, exactly how this business makes money? This is a direct test of your circle of competence. If the answer is no, the inquiry stops immediately. No punch. Criterion 2: the test of the moat. Does this business possess a durable, identifiable competitive advantage that protects it from rivals? This could be a powerful brand, a network effect, low-cost production, or high switching costs for customers. You must be able to name the moat and explain why it is sustainable. No moat, no punch. Criterion 3: the test of management. Is the management team honest, rational, and capable? Have you read their shareholder letters for the past decade? Do they talk candidly about their mistakes? Do they allocate capital intelligently? Or do they squander it on foolish acquisitions? You are choosing a management team to be your partners. Choose wisely. Questionable management. No punch. Criterion 4: the test of price. Is the stock trading at a significant discount to a conservatively calculated estimate of its intrinsic value? This is the margin of safety test. It's not enough to find a great business. You must be able to buy it at a great price. No margin of safety, no punch. Criterion 5: the 10-year test. If the stock market were to close for the next 10 years, would I be perfectly happy owning this business? This is the ultimate test of a long-term perspective. It forces you to focus on the underlying business fundamentals rather than the short-term stock price fluctuations. If the thought of being locked in for a decade makes you nervous, it is not a punch card-worthy idea. Only when an idea passes all 5 of these stringent tests with flying colors do you earn the right to punch one of your precious 20 slots. The path of the 99% stands in stark, almost comical, opposition to the disciplined punch card approach. The typical investor's approach can best be described as the lottery ticket method. They treat the stock market not as a venue to buy partial ownership of productive businesses, but as a casino where they can place small bets on long shots, hoping for a life-changing payout. Their punch card is not a clean sheet with 20 pristine slots. It is a tattered piece of cardboard, perforated with 1,000 messy, thoughtless holes. They're constantly chasing the latest fad. One day it's a speculative biotech with no revenue but a good story. The next it's a cryptocurrency they don't understand. Then it's a meme stock being pumped on a social media forum. Each purchase is a lottery ticket, a low probability bet on a massive return. They are not investing, they are gambling. The psychological appeal is obvious. It offers the thrill of the chase, the dopamine hit of quick action, and the tantalizing possibility of getting rich without the hard work of diligent research. But the financial consequences are devastating. While one of their 100 lottery tickets might pay off, the other 99 will almost certainly be losers. Their net result is a slow and steady erosion of their capital, punctuated by the occasional small win that gives them just enough false hope to keep playing the game. The punch card investor, by contrast, operates like a professional card counter in a casino. They are patient, they are disciplined. They wait for the odds to be overwhelmingly in their favor, and then, and only then, do they place a large, confident bet. The lottery ticket player is hoping for luck. The punch card investor is relying on skill, patience, and a well-defined process. The former is a recipe for excitement and eventual failure. The latter is a proven blueprint for building sustainable, generational wealth. The direct financial connection of the punch card methodology is its powerful link to the concept of long-term compounding and return on invested capital, or ROIC. A punch card-worthy investment is not just a stock, it is, by definition, a superior compounding machine. The checklist forces you to select businesses that are not only cheap, but are of exceptionally high quality. A key characteristic of a high-quality business is its ability to consistently generate a high return on the capital it invests back into its operations. A company that can reinvest its profits at, say, 20% per year will see its intrinsic value grow at a spectacular rate. The magic of compounding means that this growth becomes exponential over time. By using the punch card to limit yourself to only these types of elite businesses, you are ensuring that your portfolio is composed of the best possible engines for long-term wealth creation. The financial goal shifts from trying to predict which stock will pop next month to identifying a business that can grow its intrinsic value at an attractive rate for the next 20 years. Your job as an investor becomes incredibly simple. Buy a handful of these wonderful businesses when they are available at a fair price, and then do nothing. You let the brilliant managers of those businesses do the hard work of allocating capital and growing the enterprise, while you sit back and allow the force of compounding to work its magic on your behalf. The punch card model is not about timing the market. It is about maximizing your time stream the market, invested in the highest quality businesses you can find. This is how a small portfolio, built with discipline and patience, creates not just good returns, but true, life-altering wealth. We have now reached the final and perhaps most misunderstood pillar of our framework. We have made the case for concentration, but in the mind of every investor, a nagging question remains. What about the risk? Isn't putting all your eggs in one basket the very definition of a risky strategy? This is the most common and most powerful objection to concentrated investing, and to overcome it we must fundamentally redefine what risk truly means. The conventional financial world has done a great disservice to investors by equating risk with volatility. They teach that a stock whose price bounces around a lot is risky, while a stock with a stable price is safe. This is a dangerously flawed and superficial definition. The final pillar of our journey is dedicated to dismantling this fallacy. We will learn to separate the temporary, emotional fluctuations of the market from the permanent, fundamental risks to a business. We will see that for the knowledgeable, concentrated investor, true risk is not a scary-looking stock chart. It is the possibility of a permanent loss of capital. And the greatest protection against this risk is not diversification, but the very same deep knowledge and margin of safety that our entire philosophy is built upon. To illustrate this crucial distinction, there is no better case study than Berkshire Hathaway's largest single common stock investment, Apple. When Buffett began buying Apple in 2016, the move stunned Wall Street. For decades, Buffett had famously avoided technology stocks, arguing they were outside his circle of competence and lacked the predictable, long-term moats he favored. Apple was seen as the quintessential tech stock. Innovative, yes, but also subject to rapid technological change, intense competition, and the fickle tastes of consumers. By conventional metrics, its stock was highly volatile and therefore risky. Analysts and pundits loudly proclaimed that the old master had lost his touch, that he was abandoning his principles to chase a popular growth stock. But these critics were making a fundamental error. They were looking at Apple through the wrong lens. They saw a technology company. Buffett saw something entirely different. His deep analysis led him to conclude that Apple was not a tech company in the traditional sense. It was a consumer products company with one of the most powerful brands and ecosystems in human history. He didn't care about the intricate details of the latest A-series chip. He cared about the incredible loyalty of its customers. He saw the iPhone not as a piece of hardware, but as the central hub of a person's life, an indispensable tool with enormous switching costs. Once you are locked into the Apple ecosystem, with your photos, your music, your apps, your contacts, the cost and hassle of switching to an Android device are immense. This was the moat. It was an ecosystem moat, a brand moat, and a psychological moat all rolled into one. He saw a company that had hundreds of millions of affluent, loyal customers who would consistently upgrade their products every few years. This was a business with the predictable, recurring revenue streams of a consumer staple, like Coca-Cola or Gillette, but with the growth profile of a technology leader. From this perspective, the short-term volatility of the stock price was completely irrelevant. The market might panic about quarterly iPhone sales numbers or a new competitor from Samsung, causing the stock to swing wildly. But Buffett, with his deep knowledge of the underlying business, understood that the long-term risk of Apple's ecosystem collapsing and its customers abandoning it, the risk of a permanent loss of capital, was incredibly low. So he acted with massive conviction. He invested tens of billions of dollars, eventually making Apple more than 40% of Berkshire's entire public stock portfolio. It was the ultimate concentrated bet, based on a definition of risk that Wall Street simply couldn't grasp. The market saw risk in the stock's volatility. Buffett saw safety in the business's unassailable competitive position. The market's flawed definition of risk is driven by a pair of powerful cognitive biases: myopic loss aversion and the availability heuristic. Myopic loss aversion is our tendency to feel the pain of short-term losses much more acutely than the prospect of long-term gains. We are myopic, short-sighted. The daily or even hourly fluctuation of a stock price is a constant source of potential pain. An investor who checks their portfolio constantly is subjecting themselves to a continuous stream of small losses, which triggers their loss aversion and creates a state of perpetual anxiety. This makes them equate the feeling of anxiety caused by volatility with the presence of actual risk. This is amplified by the availability heuristic, our mental shortcut of judging the likelihood of an event by how easily we can recall examples of it. The stock price is the most available piece of information about a company. It is flashing on our screens, constantly updated, impossible to ignore. The company's underlying intrinsic value, on the other hand, is not readily available. It requires deep thought and research to estimate. Because the volatile price is so much more available to our minds than the stable intrinsic value, we overweight its importance. We mistake the noisy, easily available signal, the price, for the true, hard-to-discern reality, the value. The disciplined, concentrated investor consciously fights these biases. They understand that the stock price is just the opinion of a manic depressive business partner, as Benjamin Graham described it. They train themselves to ignore the daily noise and focus on the long-term fundamentals. They know that true risk is not a falling stock price but a deteriorating business. And they know that a falling stock price in a non-deteriorating business is not a risk but a magnificent opportunity. To properly manage the true risks of a concentrated portfolio, we need a mental model that forces us to look past volatility and focus on fundamental business threats. The most effective tool for this is the pre-mortem analysis, a concept developed by psychologist Gary Klein. This is a more structured and powerful version of the inversion exercise we discussed earlier. The blueprint is as follows. Before you make your final investment decision on a concentrated position, you gather your thoughts and you perform a specific imaginative exercise. Step 1. Imagine that it is 1 year or even 5 years into the future, and this investment has turned into an unmitigated disaster. You have suffered a permanent loss of capital. Step 2. You must then write a detailed, plausible story explaining exactly what happened. This is not a vague story about the market going down. It must be a specific narrative about the business itself. For example, if you were considering investing in a dominant software company, your pre-mortem story might be, a new, open-source technology emerged that offered 80% of our company's functionality for free, completely eroding our pricing power and market share. Or, our key founder and visionary CEO was forced to step down due to a scandal, and the new management team completely fumbled the company's product strategy. Step 3. Once you have 2 or 3 of these detailed disaster stories, you can step back into the present. and analyze the actual, real-world probability of each of these scenarios coming to pass. How likely is that technological disruption? What is the company's succession plan? This process is incredibly powerful because it forces you to identify the specific, tangible threats to the business's long-term competitive advantage. It moves your focus from the abstract, unknowable risk of market volatility to the concrete, analyzable risks of the business itself. If, after a thorough pre-mortem, you find that the most plausible disaster scenarios are still highly unlikely, you can proceed with a much higher degree of rational confidence. You have defined the true risks and found them to be acceptable. The antithesis to this deep, business-focused risk analysis is the shallow, price-focused, stop-loss mentality of the 99%. The typical investor is taught that a key element of risk management is to set automatic sell orders, known as stop losses, at a certain percentage below their purchase price, say 10% or 15%. The logic seems appealing on the surface. It limits your downside, but in reality, it is a complete abdication of thinking. It is a mechanical rule that fundamentally equates a decline in price with a decline in value. This is an amateur's mistake. A great investor understands that price and value are two completely different things. The price is what you pay. The value is what you get. The stop-loss investor has no concept of value. If they buy a wonderful company at $100 per share and a temporary market panic drives the price down to $85, their stop-loss order is triggered and they are automatically sold out of their position. They have locked in a 15% loss. A thinking, concentrated investor who has done their homework and calculated the intrinsic value of the business to be, say, $150 per share, sees the exact same situation not as a reason to sell, but as a fantastic opportunity to buy more. They are being offered the chance to buy $1 worth of value for just 57 cents, $85 price on a $150 value. The stop-loss order is a tool that guarantees you will sell low. It is a crude, thoughtless instrument that protects you from volatility at the cost of preventing you from ever taking advantage of it. It is the perfect encapsulation of a mindset that is obsessed with the meaningless fluctuations of price, while remaining completely ignorant of the enduring reality of value. This brings us to the ultimate financial connection, the crucial, wealth-creating difference between volatility and the risk of permanent capital loss. Let us visualize two investments over a 10-year period. Investment A is a high-quality, dominant business with a strong moat. Its stock price is volatile. It swings up and down wildly based on quarterly earnings reports and market sentiment. A chart of its price looks like a jagged mountain range. However, beneath this volatility, its underlying intrinsic value, its earnings power and competitive position, is steadily and consistently increasing year after year. Investment B is a mediocre, undifferentiated business in a highly competitive industry. Its stock price is not very volatile. It trades in a narrow, stable range year after year. A chart of its price looks like a gentle, rolling hill. However, beneath this placid surface, its intrinsic value is slowly but surely eroding as competitors eat away at its market share and profit margins. The conventional world of finance would label investment A as risky and investment B as safe. The concentrated, value-oriented investor knows the truth is the exact opposite. The volatility of investment A is not risk, it is opportunity. The price swings provide periodic chances to buy more of this wonderful compounding machine at attractive prices. The true risk of permanent capital loss is low because the underlying business is strong and growing. Investment B, despite its low volatility, is the truly risky proposition. Its stability is an illusion, masking a slow and certain death. The probability of permanent capital loss here is high because the underlying business is fundamentally weak. The market consistently misprices risk by mistaking volatility for danger. The entire philosophy of concentrated investing is built on exploiting this single, monumental error. By learning to embrace the volatility of great businesses and avoid the deceptive stability of mediocre ones, You align yourself with the true drivers of long-term wealth creation. This is the final and most profound secret of portfolio management. Risk is not in the bouncing stock price. It is in the business you own. And if you know your business with unshakable depth, volatility is not your enemy. It is your greatest ally. You have just invested a significant amount of your most valuable asset, your time, to fundamentally rewire your understanding of how real wealth is built. You now possess the foundational logic to break free from the cycle of mediocre returns, a cycle that traps 99% of investors. You understand that the comforting lie of diversification is a guarantee of average results. You know that true financial advantage comes from the deep knowledge of a few great businesses, the courage to back those ideas with conviction, and the wisdom to distinguish temporary volatility from permanent risk. This framework is not just a collection of theories. It is a powerful mental tool, a new lens through which to see the world of investing, one that can have a transformative impact on your financial destiny. But understanding tuneful why concentration works is only the first step. The true masters of this craft, like Buffett, link this principle to another, equally powerful mental model, a way of evaluating the very DNA of a business before you ever invest a single dollar. Knowing you should concentrate is one thing. Knowing how to identify the truly exceptional businesses worthy of that concentration is another entirely. There is a specific set of qualitative and quantitative traits, business genetics, that separates the good companies from the truly great, world-beating investments that can compound your capital for a lifetime. That next piece of the map, the framework that separates a good company from a truly great investment, is what the algorithm has brought to you now. The video on your screen isn't a random suggestion. It is the missing link that connects the what and why of concentration with the how of execution. It is the vital next step in assembling your complete mental arsenal. Average investors are content with average knowledge. They scratch the surface and move on. But you have demonstrated the patience and the intellectual curiosity to learn at a much deeper level. You have proven that you are not part of the 99%. The question is, are you ready to complete your journey? Are you ready to acquire the final piece of the puzzle that the world's greatest investors use to build their fortunes? The choice to continue your ascent from amateur to professional, from speculator to business owner, is yours. Click and take the next step.